Thanks, Ian. If we just move on to the next slide. So what I'm going to talk about is actually how we work out which people are supposed to be automatically enrolled and which people don't. And what's going to happen and what are the implications of that. Now what the rules say is that at each payroll run, whether it be weekly, monthly, fortnightly, lunar, all unpensioned workers have to be what's technically called assessed to see if they have to be enrolled in the scheme. And the basic rules are that employees between the ages of 22 and state pension age who are earning more than £833 a month or £192 per week have to be automatically enrolled. Now those figures aren't an average, and if someone's on variable pay and 1 month earns 800, he wouldn't need to be enrolled. But if the next month he earns 840, you would have to enrol him in that month. Does that make that clear? So there's various things, triggers that have to be looked at each month. The first one is people's birthdays, obviously, and when employees join the company. And then the second thing is, what are their earnings? There's another subtlety, is that the people who are not automatically enrolled without a form have to be given the option of actually joining. So they need a separate piece of paper, if you like, that gives them the option of joining by writing to the employer saying, I wish to be in. And the third catch-all is that the employees who previously opted out have to be automatically re-enrolled if they're eligible every 3 years. So what we've got here is quite a complex piece for any payroll. If people have asked me why are the rules 3 books long, and the basic reason is that the government did not actually make it compulsory. If they had made it compulsory for everybody, we wouldn't need all these rules and we wouldn't need the systems. So when your CEO or managing director asks you why is this so complicated, it's because they decided to pick and choose and give options to opt out and also introduce rules like the 22-year-olds, etc., etc. Okay. So, what are the implications? As we said, a trigger, if you pay monthly, a trigger is £833 a month. And unfortunately, that trigger can be actually sort of gone over by paying someone overtime or a bonus. So there's all sorts of subtleties within here because it's the month that you go through the 833 that you have to be enrolled. Obviously, the re-enrolment that we spoke about after 3 years creates a record-keeping requirement, and different letters have to be sent to different people. So the people that are enrolled are obviously going to get the letter that says you have been enrolled, but the people who you haven't been enrolled have got to have a separate letter telling them they can join if they want. So how's all this going to be managed? Systems are being invented as we speak, and there's three real broad types. Some payroll providers and bureaus are providing providing assessment and communication modules. Sage are a good example of this. So for more money, Sage will give you a module that's added onto the payroll system, and that will automatically assess, keep records, and produce the right letter for the right person at the right time. So it will automatically produce letters for the eligible people who have to be enrolled, and it will also do the non-eligible employees. Some payroll providers are only doing the assessment. So that means that somehow you've got to juggle the letters and make sure the right people get the right letter at the right time, and that has to be, if you like, a manual operation, or you find another system for actually doing it. Some pension providers are providing this assessment software bundled with the software that you would use for uploading monthly premiums. Again, some do it, some don't. So it's obviously a case of horses for courses. But the biggest provider of automatic enrolment pensions is going to be Nest. You might have heard of it. It's a government-backed organisation set up specifically by the government to deal with automatic enrolment. They are not providing any of these tools. And the last category is third-party suppliers, and more and more software companies are producing more interesting stuff. This is a moving target because the market is just developing. The software system, because the biggest companies went first, the software systems that had to be developed were extremely complex for those, and those systems that are already developed will be too complex for smaller companies who are coming later. So there's a continuous development going on. Typically those third-party suppliers will be offering at a price competitive to the payroll providers and bureaus for this software. The problem is, for those of you who understand payrolls, is that you have to keep, if you like, a third database. There will be a database of people who are in the pension scheme. There will be your employee database contained within the payroll, and then there will be a third database that is used for the assessment, and that needs a feed from the payroll to be able to run it correctly. So all of this is quite complex, and it's an evolving market, and I would suggest that one of the things that employers will need advice about is how to correctly assess and keep the records and communicate with employees.
Okay, thanks very much then, Mike. As you can see, there's an awful lot of information that Mike's provided there that you need to take into consideration, and as you said, it's a moving feast really. It's a very immature market at the moment, and I think over the years we're going to see more propositions come to market, so there may be further developments that we can help with at that point in time. What I want to move on to now is looking at some of the financial impacts that auto-enrolment are going to have on you. There's the obvious, which is pension contributions. That's going to be by far the most expensive cost for all of you on an ongoing basis. The government has, or the pensions regulator has set out a number of different ways that these contributions can be made. What we think is, for the majority of individual companies, the most cost-effective way of building the contribution structure is going to be through something called qualifying earnings. Now, qualifying earnings is a band of earnings. It starts at the lowest point is, as you can see here, 5,772 for this year, which is the lower earnings threshold for national insurance, up to 41,866. So that's the upper earnings limit for basic rate taxpayers. Now, the way that this one works is anybody earning in between those two figures will have the calculation done on that amount of money. If you're earning below that figure, or any money you earn below that figure will not be used in the calculation. Any money over the upper figure will again not be used in that calculation. So we've got about £35,000 of potential earnings that this can be assessed against. Now, if you went down this route, the employer contribution ultimately is going to be 3%. The employee will have to contribute up to 5%, or a minimum of 5%, because we need to have a minimum overall contribution of 8% for this level. There is three other options, as we can see on this screen here. So we've got full basic salary. Now, for full basic salary, that minimum contribution would increase for yourselves from 3% up to 4%. Now, this is because, depending on the structure of the pay for individuals, they may have a small basic and larger commissions. So this is to get away from companies who decide to go down that route and try and get away with paying less than they need to. You've also got full basic salary if it's more than 85% of the total earnings for an individual, and again that for yourselves and employers would drop you back down to 3%. But you've then also got another option there of total earnings, so total P60 earnings. For you that would still be 3%, but it actually reduces on the overall figure for employees. They only have to contribute 4%. So you see there's a number of different options there that really need to assess and work out based on the way that you pay your staff, which is going to be most cost effective, what one you want to go with. We can obviously work with you to work out which is going to be the best way to go. But as we said, for the majority of companies, the qualifying earnings is going to be the most cost effective option of these. One thing that's been brought in is phasing. Now, initially, the government wanted to bring everybody in on these figures that I've already explained to you, the 3% employee and the 5% employee. But from consultation, they now realise that this is too much of a jump and it's going to potentially cripple so many companies and be unaffordable for individuals. People will end up opting out and they would have got nowhere with the ideas that they've had for auto-enrolment. So what they've decided to do is build in phasing. So, as I said earlier, October 2012 is when auto-enrolment started. So from that date up until October 2017, the minimum contributions that you will have to contribute as an employer is actually 1%. And if we use a qualifying earnings definition, it would be 1% of that band earning. So anything over 5.5 and under 41,000. And again, the employee would also have to contribute 1% of those figures also. In the future, when we get to October 2017, that's going to increase. So it's going to become 2% for yourselves as employers, and your employees will have to contribute 3% if they want to stay in the scheme. And then when we get to 2018, which is when everybody has been through this process, even the start-up companies, we're going to then become in a position called steady state. And that's when we get to the 3% for you and the 5% for your staff. And that's where we see that continuing for the foreseeable future afterwards. As I said, contributions is the major factor, a major cost for you, but it's not the only cost. We really think that there's 3 areas of cost that you need to be taken into consideration. Mike was talking to you about this middleware and how that's going to be built into your processes. Obviously these contributions, if you don't have a scheme in place at the moment, there's going to be extra work you're going to be needing to do there. There's going to be changes to your processes and your systems with this coming in, whatever you've got in place already. Now that's obviously going to need to be put together by somebody. Now is that going to be yourselves? And if so, are you going to employ a new member of staff to help with that? Are you going to take that on yourself as an employer? And obviously you have to spend more time doing so, or are you going to look for an outsourced party to help with that? For instance, a financial advisor or an accountant. Whatever option you choose, there's going to be costs. So you're going to have the cost for the administration. You're going to have the setup costs and the day one costs, so any initial outlay that you need to pay in. But then there's also going to be the ongoing cost to pay for these ongoing services, either from professional and also for the software that Mike has been mentioning to you. We know that we've got the hard cost of contributions. So really what we're going to be looking at there is who is eligible within your firm and who is not. Contribution structure we're going to be going over. There are things that we can do to try and help reduce those. Salary sacrifice, these kind of things, but that is adding further layers of complications, and not everybody's going to want to go down that route. And then finally, we've got the compliance and ongoing administration. So in order for you to be able to keep to the rules that have been brought in by the pensions regulator, you're going to need to make sure that you are making these records, that you're putting in your contributions on time, and that you're putting in your scheme returns on time. And again, if there's going to be help needed there, then who's going to do that? Are you going to do it in-house, or is it going to be a third party? But if you don't do these things, there's going to be other costs, which are going to be enforcement, that are going to be brought in by the pensions regulator. Now, actually, that leads on quite nicely for Mike to cover that in a bit more detail.